we're going to talk venture capital. We're very lucky today. We have an investor with us, obviously, who invests a lot of money in the venture space, and that would be Stacey, and I'll go into her background and talk with her in a moment. Eugenio has his own fund, so we'll talk about him and his investing style, as well as David at Vibe Capital also has his own fund. So obviously the two fund masters that are in the room with us today are looking for new dollars. So those family offices that are looking for great investment opportunities, you've got two of the best sitting right in the room with you. Let's talk about venture capital. What makes venture capital so amazing is that it really began, after every time there's been a crisis. So, we put together some great ideas of Black Monday right after the crash of 29, dot-com bubble, financial crisis in the 80s. There's just been so many disruptions that make venture capital the perfect place and the perfect moment for investors worldwide. So how did it really all begin? If we step back and we think about the Rockefeller family, we think about the Phipps family. They were the very first investors in very early tech. And if you step back even farther, you think about the Rockefeller families. They were originally the outgrowth of venture capital with Venrock. So venture capital, through all of the wealthy families, and that's why it's so great to be here today at the Family Office Forum, have always been at the forefront of putting money into the right technologies, the right individuals, the right groups to push technology forward. I'm going to have to agree with Marty this morning. Expectations obviously are through the roof of what the returns could look like for venture capital over the next 5 to 15 years. Valuations have come down, which means that it's gotten a little easier for venture capital families, those that are exposing and looking for allocations, to get in. And this is obviously the opportune time. So, David, you're closest to the camera. I'm going to start with you, if that's okay. This is David Greenblatt. David is the general partner of Vibe Capital, based in San Francisco. And an interesting factoid about his background is that he worked at Facebook for 10 years, from 2007 to 2017. And he watched the company grow from millions of users to billions of users. Now, those of you that have seen the movie that's a little old now from 2010 called The Social Network about Facebook, it was really an introduction, I think, to venture capital for a lot of people about how this works. So, David, talk a little bit about Vibe, talk a little bit about your background and yourself, and we'd love to hear what you're thinking.
Sure. Can you hear me?
Perfect.
Yeah. Cool. Hey, everyone. Dave Goldblatt from Vibe Capital. If you want to get in contact with me, Dave at vibecap.co. Before, after, during, feel free to email me. So a little bit about my background. Like Matthew said, thank you for the introduction. I was basically right out of undergrad at Facebook from 2007 to 2017. I was employee 180, and I was there until there were about 50,000 people. So I have a relatively unique perspective of seeing this absolute rocket ship of, I think there were 15 million people just on Facebook.com. Was there a few years later, we IPO'd. Then we, by the time I left, there were 3 billion people across all of the various Instagram, WhatsApp, Facebook.com, Messenger, Facebook app, etc. That really gave me a firsthand look into one, like, what does it look like and feel like to be on a rocket ship of this exponential growth that I think everyone in venture capital is trying to get towards and invest in. And two, what is the from a product perspective, and two, what does it look like internally? Who are the types of people who are really pushing forward that tremendous growth trajectory? And I use that lens as I evaluate people and founders and companies that I'm talking to see, not necessarily one-to-one, but does this have the same feeling and the same energy and the same vibe as a tremendous growth opportunity, an exponential growth opportunity? So after that, did a startup for a couple years, really got deep into the startup ecosystem, going to different hackathons, which is just a group of people getting together and spending the weekend building something, visiting hacker houses, which is kind of like a fraternity or a sorority, but for people who are working on technology. And then around 2020, around COVID, started to see the inflection point. And Matthew, you spoke to this as well, of during these great downturns, this volatility, there are all of these institutions that are starting to unravel: education, finance, government, media even. And in place of that, there are going to be these tremendously disruptive companies that are born that are going to not only have a huge impact on society, but produce these gargantuan returns. So I dove into that, solidified my thesis. We're very deep into Web3. We're very deep into artificial intelligence and some of these deep science sectors of robotics and genomics. And we're really excited about some of the companies that we've invested in so far. And we are very excited about the companies that we are planning to invest in. We're in diligence with a few other companies that I can't speak to right now. But we are still looking for LPs. Yeah. I'll drop the hints later. It has something to do with neurological diseases.
We'll drop hints later. So let's go to our big investor of the group, and that would be Stacey Feinberg. Stacey runs a firm managed by herself called 4th-5th LLC. She's based in Los Angeles. And Stacey has a undergraduate at Northwestern and an MBA from Harvard. Now, she has a family office, and her focus is funding on emerging female entrepreneurs. She's also an angel investor. What that means is she's very early in getting the startup going, and she's always looking for 20% returns. And I think one of the really amazing things about talking to Stacey over the past couple of days is that she's an investor in Tiger, which is Julian Robinson's original firm. So it's very hard to get in that door. So Stacey, talk a little bit about your background, what you're looking at now, and obviously everybody in the room is very fascinated about the idea of female entrepreneurs and how you're helping them and some of the boards you sit on. So give us a glimpse into your firm, 4th-5th Capital.
Sure. It's a pleasure to be with you today. So back in the days when there were not a lot of hedge funds, my husband at the time and I started a hedge fund. We would go to investment conferences and there were 150 of us. Those same conferences blossomed into having 10,000 people after a while. But this was the mid to late 90s through the 2000s. And while we did great financially, quite frankly, I never felt that we really made a difference in the world. But, we created jobs, we created value. But I always dreamt that someday I'd be able to use the funds that I was lucky enough to have acquired to actually make a difference at the grassroots level. Fast forward, we closed our fund. I think it was about 2009. The year before, we were number 29 in Barron's top 30 hedge funds. And then we had a tough year and the high water mark was too high. And we realized the moral thing to do was to close the fund.
What's a high water mark for those in the room?
The money that you have, the amount you have to get above, when you're down, we never had a down year. We had an average of 37% for 10 years. And then all of a sudden we're down 70%. We know it's going to take forever. And we probably aren't going to be able to get above that. To take capital from people and take, even 1%, even it's 2 and 20, but even to take 1% to sit waiting, you can't charge people to make that money back. So long story short, it was the right thing to do for us. It was the right thing to do. Well, we ended up getting divorced and we divided our assets. And I realized this is my opportunity to do something special with the funds that I was so fortunate to have acquired. And I thought, well, what do I do? And I had done a lot of philanthropy and a lot of women are very, very comfortable with not-for-profit. But I was very comfortable with for-profit. And I realized that if you make a profit, then you can take your money and give it to nonprofits. And that's how you can be a philanthropist. So I decided to learn. We're investors in venture capital through Chase Coleman. We were investors through, we were in the very first when Julian left, and we were in the first the hedge fund, and then the very first PIP, the private equity investment. And then I've been in every private investment, every venture since. We had 2 last year. It used to be that you would wait 3-4 years between having funds, between having a venture fund. Last year in 2021, there were 2. One in March, PIP 14, and one in October, PIP 15. That's extraordinary. That's how fast the world of venture was moving. And the money often wasn't called for quite a long time. Money was called immediately because there was so much money to work. Okay, great returns with Tiger. Absolutely no complaints. I'm so very grateful to them and to be a part of them. But I get my statements and I feel I wasn't really a part of making those decisions, making those things happen. And that gave me the idea to teach myself to learn how to become an investor and be able to do this myself.
I think that's an important pivotal moment in her career because she's now gone from fund to funds, a large fund, to where she's now stepping out and using all of this amazing education that she's gotten and investing directly into founders. And somebody like David Goldblatt is a founder, obviously. And David and his fund, Vibe Capital, is out there looking for these new unicorns. And it's Stacey's responsibility within her own family office to work with guys like David and help find these new unicorns. So I think that moment where you went from fund to funds, actually going right into the founders, is so amazing. And I'd love to hear more about that. So let me just move on to Eugenio, and then we'll come back full circle. So with us today, sitting next to David, is Eugenio Gonzales. He is a lawyer. He's a partner at his firm called Plug and Play Ventures in San Francisco. And it's also a global family office. So you're going to hear from him in his background that not only is his family office Plug and Play based in the US, but they do work with multiple companies offshore. He's MIT background. He has a law degree from the University of Chile. So obviously, bilingual and well-traveled. And he has been focusing on startups, tech, fintech, cybersecurity, and enterprise software. So a little different take than I would think on most, because he's such a large family office with over 600 employees around the globe. So Eugenio, give us a little glimpse into your firm, Plug and Play, and we'd love to hear a little bit about you. And again, I know you've got these strategic partnerships with outside firms, some of these Fortune 500 companies. So quickly try and just sort of pull that together for us, because you really are a unique type of an investment company.
Yeah, absolutely. Thank you, Matt. So hi, everyone. My name is Eugenio. As Matt mentioned, I'm a recovering lawyer. So like many folks, made a few mistakes early in my career, ended up being a lawyer, did M&A and finance for a number of years before I realized I was sitting at the wrong side of the table. I went to MIT, where I worked with a few startups and funds before joining Plug and Play. I would like to know that Plug and Play is not my family office. It's owned by the Amides. But like many other family offices, it started off with real estate. And very interestingly enough, they had a number of different real estate venues, and they started offering space to some startups that were early tenants around Palo Alto. The first tenant that they had was Google. The second one that they had was PayPal, which they invested in all of them. Then the third one was Danger, which ended up becoming Android. And a number of different startups came by. And so they realized that there was a monumental opportunity here that they could seize. And so we have a pretty large campus now in Sunnyvale, where we have, it's a Philips semiconductor factory, or used to be, where we now house a number of different startups. And interestingly enough, as you mentioned, Matt, the model of the family office has evolved over time. When you're selling capital or money, which is a commodity, you need to have a differentiation. And so we've thought long and hard about what is our edge here. And Plug and Play has evolved to become a corporate innovation platform, where we have now over 535 corporate partners. Think of companies like Panasonic, Nintendo, PepsiCo, Progressive, you name it. And these folks come to us because they want innovation, which is another way to say that they want an edge over their competition. So in order to serve those corporates, we have over 600 employees across the globe, offices in every single continent. And out of these 600 folks are assisting the corporate partners, 122 of them sit in our ventures team. And this is the team that's sourcing the latest and greatest startups that we can help our corporate partners with. And that's how we, at the same time, help entrepreneurs, by being able to make those introductions into these large Fortune 500 entities that are a partner of our platform.
And how would a family office that's in the room today or watching through video invest through you, invest through Plug and Play, invest through your family office? What would be a first step to getting an introduction to you?
Yeah, great question. So along the platform that we have, we've been investors throughout all of our history. And so we have a number of different vehicles that I would be happy to talk about later on if anyone wants to engage. That are sector specific. One of the main things about Plug and Play is that we've developed an expertise in different areas. So we have over 15 verticals. I oversee the investment team on fintech, insurtech, and enterprise, a team of over 30 folks across the world in offices like China, Japan, Singapore, Germany, Spain, Sao Paulo in the US. And we make a number of different investments. Last year, we did 210 investments where our average check size is $149,000. So on average, deploying 30 million each year.
Nice.
In addition to that, we have separate vehicles that are doubling down on the winners of all of our portfolio, where we have over 1,600 companies in the existing portfolio. And that's where the family offices can come in and join us as an LP.
So David, you and I and Eugenio and Stacey have been talking a lot about San Francisco and the area and Silicon Valley. And most people come to Silicon Valley and think it's an ATM, but it really isn't an ATM, right? Because Silicon Valley is about building and doing deals. It's about culture. It's about technology. Talk a little bit about, that ecosystem inside of Palo Alto, and help us understand a little bit more about your verticals as well.
Sure. So I think there was this popular narrative around COVID that San Francisco is done, everybody's moving to Texas or Miami, and there's no reason to stay in San Francisco. It's, just a lot of filth on the streets and nobody wants to be there. I've been in San Francisco for 15 years. The culture around building and really being a technologist is so much stronger here than it is anywhere else in the world that I've been to. It's like going to New York and being in finance. Everyone is talking about finance all the time. It's like going to Milan and talking about fashion. It's the exact same thing. This is embedded into people's identities in the San Francisco Bay Area. Where this helps, and to be totally fair, it is being democratized a little bit, and the internet is a leveling force as well. But it's an unfair advantage to be in the San Francisco Bay Area. It's just more people per capita working in technology and internet-related businesses. So, diving into the specific verticals that my firm deals with, we really feel that over the next 10 plus years, there's going to be this inflection point of a few really key exponential technologies. Those technologies are AI, artificial intelligence. And I don't know if people have been keeping up with the news over the past 6-8 weeks. There have been some really cool advances, DALL-E, stable diffusion, where you can generate an image just by typing in a few words.
David, stay with that. That's really interesting. So I'm a family office. I've got $100 million burning a hole in my pocket. I'm thinking about AI. Just pick on one of those companies with a name or without, and tell us a little bit about what is AI. Give people a little bit more room behind the curtain.
AI is generally a way for a computer to, I'm trying to get it down into the simplest terms. It's a way for you to load in a bunch of data, and a computer draws conclusions off of that tremendous amount of data. Now, the simplest way to do this is just you plot points on a graph and you draw a line through it, and that's like a line of regression. Really complicated ways of doing this are you feed in 100,000 pictures of a cat, and then you come up with an algorithm and you say, find a cat from new pictures. Where this leads to is now this computer can learn and take commands and take next steps towards the things that make humans intelligent. So you can type a few words into a box right now. This is available to everyone. It's called DALL-E 2. Type a few words into a box, ginger cat floating through space in the style of Kandinsky with a supernova in the background. It'll give you 6 pictures in under 30 seconds that are phenomenally done. Then you can change the style and you say in the style of anime. Then you do in the style of a kid's book. And these things all are, it's free, well, not free to use. You get free credits, but these things are so incredibly powerful. People don't realize that pretty soon all of your media is going to be artificially intelligence generated. You're going to have probably all of your influencers on Instagram are going to be artificially intelligence generated. You can plug in a few words into an artificial intelligence text generator and it'll write your essay for you. So these things are basically giving you superpowers we got a new guest, giving you superpowers for humanity. If you think that TAM, the total addressable market, is going to be anything under trillions and trillions of dollars, like I got news for you. In the next 5 years, it's just going to like look like not even a hockey stick, just the straight
Right.
line up.
Let me quickly move over to Stacey. So Stacey, it sounds like we're talking about unicorns here, right? So David's talking about trillions of dollars. David's talking about inflection points. David's talking about unicorns. So just for the group, a unicorn is a startup that has reached this interesting plateau within venture capital called $1 billion, right? So there's over 1,000 unicorns today that have a value as a company of $1 billion. Instacart, Carva, SpaceX, Reflex Solutions, Noom, and just sort of a fun fact I figured out just a few days ago, Amazon was not a unicorn when it went public. It had a market cap of $438 million. So you know where Amazon is today. So Stacey, help us a little bit with the unicorn idea. Most importantly, some of the industries, finance, insurance, tech, telecommunications. Talk to us about investors, funds, and if they get lucky, they get a unicorn.
Well, like ironically, like every industry, the book industry, the movie industry, 8 out of 10 of your investments are going to go under. And you just kind of, you know that. One, you're going to get your money back, which to me is a win. I put that in the W column. But one of them is going to be a 20X. One of them is going to be a unicorn. And they often say in venture capital that you are better throwing more darts. Now, it's not the term spray and pray. You don't do that. But you do want to have as many, investments as possible. You keep money for future rounds. But, you have to realize that there's going to be an 80% fail rate, typically. It's high risk, high reward. But the unicorns, what's interesting is it's just like there used to be very few billionaires in the world. And now there's thousands of billionaires in the world. It's shocking what's happened. Same thing with companies as valuations have gone nuts. But now with the current market that we're in, we're going to see a little bit of a reduction in that. But the one thing that you have to remember too is that a lot of these companies, they are based on, they have a valuation, but some of them aren't even profitable. Many of the companies that are the biggest companies that we know of still aren't profitable. And everything is based on future revenue, future growth. There's lots of other things that you have to take into consideration. It's very different than the public markets. I had a lot of companies, liquidity events happen in 21, a lot in 20 as well. I was getting enormous amounts of stock. The prices were doubling and tripling in the public markets. And this past year, they've now gone down. Some of them, my Peloton is down 80%. Now, my basis in that is $3. So even at $7.50, I still don't have a loss. But a year and a half ago, it was $165. So that's a big loss. So you have to pay attention when you get in. So public markets are great because you can buy in the morning and you can sell it in the afternoon. So a lot of times people say, I want to, and by the way, when you're in the private markets, you have a 6-month lockup when you have the stock that you can't sell it right away. So you have to hope that in that period that your stock is going to stay where it came out at the IPO or go even higher. So there's a lot of different things that you have to factor in. But again, it's very exciting to be able to get in at a very low basis. And then just as important, you have to pay attention once you get the distribution. And the liquidity event can either be a merger and acquisition, or it can be a sale to a larger company or an IPO. But you've got to pay attention once it becomes public. It doesn't end once you've got the liquidity event.
Well, that's a very interesting point. So Eugenio, I'm going to ask you to sort of pick up on that a little bit, because I think, once there is that moment when, a young company either gets absorbed into a larger company or it does go public, things really change drastically for that founder. So yesterday, Bill Gurley of Benchmark came out and he said, quote, why founders should ignore micro economic conditions and go into launch mode. Timing, as they say, is everything. What is he trying to convey to the group? And more importantly, let's really talk about that transformation from sort of a quiet little private company to a public company. I think those are just 2 areas that I'd love to hear from you.
Hey, Matt, can I just cut in for 1 second here? So I want to get, Stacey made a real salient point here. So overall, venture is still subject to macroeconomics, right? So there has to be a buyer for your product, no matter how great it is. So if you have a B2B product, there has to be businesses who want to buy your product. Same thing with B2C, consumers that want to buy. I mean, so Stacey, does that factor into your investing? Like there has to be a buyer?
Of course. course. Yeah. And you never want to go with the founder who says, I'm going to die with my company. I'm going to go down with the ship. No, no, no. We want to sell your company.
Right. So I'm just saying, so we're in a really bad macroeconomic cycle, I think, for the next few years. So I think that's a consideration, isn't it?
Yeah, absolutely. But here's the thing. Whereas I was pouring my money into equities before because, you know, I could buy something in the morning and sell it in the afternoon and get my 10% or whatever it was. I'm not feeling that way right now. And so I'm actually putting more money into venture now that I'm putting in alternative asset classes and a lot less in public markets.
I think that the point here is...
Yes, go right ahead, Eugenio.
Thanks, Matt. I think what Marty was alluding to is if things are not looking great on the macro standpoint, then why go into venture? I think this is to the point that you were making, Matthew, about what Bill Gurley was saying. Now is the right time to actually go into venture capital, because if you are early enough, it doesn't really matter how big the outcome can be. It's still going to be a monumental return for your portfolio. We're talking about getting early at the point where Dave comes in pre-seed, where I do investments, which is more seed and A. These are companies that still have so much upside. Then even if you hit a unicorn, the returns are going to be 50x. That's what we're talking about here. So now more than, yes, Matt.
Go ahead, keep going. I'm sorry, keep going.
No, why now is the time, as Bill Gurley was mentioning. We're seeing, for instance, Facebook doing a gentleman's layoff, which is basically doing a reorg for the first time, hiring freezes across the board. What's happening is people are adjusting to what it's going to happen, but it's now going to be better for entrepreneurs to go out and hire talent, which they were competing with against the likes of Google, Facebook, and all these very, very big companies that have a lot of budget to hire engineers and hire talent across the board with high salaries, equity, a lot of perks. That equity upside is not going to exist anymore, or for the foreseeable future, it's going to go away in big tech. And all these engineers that are starving for that upside are going to join in startups, and that's where you're going to make your money as an engineer. And that's the reason why now is the right time to go out and build something.
I couldn't agree more. This is aligning a little, unfortunately, too much with the thesis of my firm, where there's going to be a lot of volatility and blood on the streets. When there is blood on the streets, when society is not doing well, that is the time to start disruptive organizations, because the systemic needs of society are not being met by the traditional organizations. So you take a look at the 70s when Microsoft and Apple were started, not the best time to be in America in the late 70s. You take a look at the 2000 vintage of Amazon. That was, you had the 2001 attacks and the 2000 .com bubble. You take a look at 2008, where you had Airbnb, Pinterest, Snapchat, Uber, so many great ones. So not only is that happening, you also have the poor macro conditions that are allowing really talented engineers to leave their cushy corporate jobs who want to go into entrepreneurship. And not only that, valuations in the early stages have dropped 25, 50, sometimes even 75%. So all these companies are on sale compared to 18 months ago. So you get the opportunity to, instead of own, 1% of the company, you can own 2, 3, 4. We had a deal that we did where we owned 6.5% of the company in a really, really promising additive manufacturing company. So it's just, for us, it couldn't be a better time to invest in venture capital.
So Stacey, let's stay with the theme, deep valuations. Eugenio talked about, pre-seed, seed, Series A, Series B. Catch up all the new family offices that are trying to learn about, stages of investor capital. And then I'd love you to segue into how do VC firms, the actual firm we're investing in, create more value?
Well, first of all, I also want to say from an investor's standpoint, everything is about what vintage that you're in. The best vintages that I were in were created during Black Swan events, during financial crises. So this is a great time actually to put your money to work in venture capital. My funds from 2015 were fine. My funds that started in 2008 and 2009 killed it. So you really want to look back and see what the best years were for a lot of these funds. And as far as companies, so it's kind of interesting. Angel is where you start off, right? That's where you put in your own money, you bug your parents, you max out your credit cards. Friends and family is where then you go to all your friends and family until they're so tired of you asking for money that they say, you know what, leave me alone. Then that's how you get an MVP, a minimal viable product, where you can go out. So it's not just an idea. It's not just a drawing on the back of a napkin. And you do a pre-seed, which then is outside angel investors, which I often will do. Seed, you usually have a product and you want to go further with it. So you're still usually at the smaller VC firm. Once you get into Series A, you are going to start having larger VC firms. And of course, B, the checks become much larger. This is what was so interesting, is it used to be that a round that was seed was, they were asking for a lot more money and having much higher valuations early on. And you'd say to somebody, you're seed, but you're presenting yourself as Series A. And they'd say, yeah, I am. We are, because that's what the market is getting. And it was very frustrating for investors. Finally, now it's a buyer's market where we can say to people, no, your valuation is not $8 million. You're just a good idea. Your valuation is 4. And here's why. And different rounds raise different amounts of money, but they also have, it's based on the valuation and the amount of money that determines whether you're pre-seed, seed, Series A. And we're finally seeing it go back to where it should be.
Talk about just briefly, if I'm a family office and I want to put money in and we've got a down round, can I ask them that I don't want to be dilutive going forward if I give you a little bit more money, right? I always want my 6 or 7% in the fund to always be 6 or 7%.
At the angel round, I'll be quite honest. There's usually a lead investor. I often don't lead. I'm more comfortable having a lead and then coming in. I like to see the cap table. I like to see people that I recognize on that cap table, smart money. So usually the terms are already determined for you, which is okay by me. But my check size is typically, I'll come in at 50,000, 100,000. I'll go up to about 250,000 Series A. That now can be Series B because things have changed so much. So you have to have a certain amount of, money, skin in the game to be able to start asking for preferred things or be willing to come in as a lead.
Gotcha. Very good. Thank you. I'm sure a lot of family offices appreciated that moment. So Eugenio, you and I were talking last week or earlier this week about, why VC is the best family office asset class for the next 10 or 15 years. You put it so beautifully. You said that tech is humanity, volatility today equals new boundaries, and disrupted valuations equal discount. Talk about those 3 themes, because I really think it's important over the next 10 or 15 years for companies like David and yours and others, that this is the best time to be in the asset class.
Yeah, absolutely. I think as a family office, when you're thinking about constructing a portfolio where you're allocating a small percentage of your overall dollars to venture capital, you're going to see the majority of the returns coming from that small portion. Granted that it's very risky and it's illiquid for good reason. You want to see those companies grow into those valuations. And as Stacey was mentioning, sometimes they get a little bit ahead of their skis. And that's why we saw in 2020 and 2021 a very frothy market where companies were racing at a multiple on their revenue that was beyond of what you would normally see. But I think going forward with what's happening in the macro space, a lot of tension globally with what's happening in the Ukraine, in Taiwan, with China, Russia, a number of different areas, people are going to focus now more than ever, instead of an emerging markets, going back to the US. And in that regard, I think the majority of the upside is still in early stage venture capital, which is where Dave and I focus. If you're building a balanced portfolio, you need to allocate at the very least 15% into this asset class. And if you're following David Swenson's theory, the reason why Yale and all these endowments have been so successful over the past few years is because they've allocated even more so into private equity and venture capital, something of around, correct me if I'm wrong, Matt, but something around 25% of their allocation.
It's a really big number, and it's gotten bigger. So if I've got $1 in my portfolio, it's usually between 25 and 40% into alternative investments. And then from there, you can break it down. But obviously, venture capital used to be right around a 15%. And you're right, Eugenio, they have now bumped that to 20% of an alternative investment portfolio. At a minimum, should be at 20%.
Correct. And so
go ahead.
No. I just wanted to finish by saying, I think some of you might have read on the news that I think Princeton now has enough money in their endowment that they probably don't even need to ask for tuition. They can cover all their costs basically because their endowment returned 43% last year. We're probably not going to see that.
What they invested in? Were they directly into founders like David? Were they into funds? How did they get to that 40% number? And I know Harvard is there, and Stanford is there, and Princeton is there, and Yale is there, and MIT is there. They've all done phenomenally well in the last 15 years because they did exactly what their premise tells them to do. Every year, put money to work. Yes, they're raising it from all of their alumni, but they're putting money to work. And I think that's so important for the family offices listening. You can't just come in today and then in 3 years maybe do it again. No, you need to come to the table, as Stacey had said, every year early with that $250,000 to $1 million or more check to asset allocate your portfolio. So I'm sorry, Eugenio, continue with the example.
That's absolutely right. How did they do it? I think over time they build relationships with what back in the day were emerging fund managers like Dave and I. And then eventually those emerging fund managers, which tend to outperform established firms, actually started returning the lion's share of what they had in this asset class. And so I think it's very important to start building those relationships early on, start betting in emerging fund managers, start getting in those early vintages, the same way that Stacey said she was in Tiger early on and she was in a number of different hedge funds early on that return a lot of the capital. And then as firms usually go and become more established, the returns turn to normalize, they grow, they need to now deploy more capital, the return starts to shrink. But if you want that asymmetric return, it's usually more around this stage, pre-seed, seed, for emerging fund managers, the ones that are going to be able to return a lot more capital.
I think another point to make is, what are the endowments that are doing so well? Princeton, Harvard, Stanford, Yale. These people are extremely intelligent because they are around all of these incredibly smart people that are graduating from their undergrad and graduate programs. Why do you think they're producing asymmetric returns? Because they're investing in these incredibly intelligent founders, and they have the network and the relationships to invest in these incredibly intelligent founders. So it makes sense that they have this access to the founders, and that is what is driving the asymmetric returns, which shows you a good venture capital investment, something in the top 10 to 20%. If you find a fund manager that can vet these founders, look at the returns that have come from the Harvard endowment, Princeton endowment, MIT endowment, et cetera. It can be very, very, very good on the upside.
So for those of us listening today, again, asymmetric returns, access is key to these managers. As Eugenio said, edge, you must have an edge as not only an investor, but obviously as a founder. So David, at the beginning when you introduced yourself, and you talked a little bit about Vive Capital, you were saying there was 2 or 3 companies that you're really excited about. Could you share if you can't share the names, at least the technology, so the family offices in the room understand what they should be looking for as they ferret out some of these really great investments?
Hey, Matt, the answer's got to be short. We got only about 2 minutes left.
Okay, so we'll let David finish, and then we'll go around the room for just last thoughts. David, go right ahead.
Very quickly, it's the disruption of the entire science industry. There's a way to use blockchain technology to undermine these middlemen that have been taking all these profits from researchers, pharmaceutical researchers, laboratory participants, using these, and it's still very early, but if you use these crypto blockchain primitives to spread the profits across everywhere, you can really disrupt this trillions of dollar industry in pharmaceuticals and science. So we're really excited about that.
Thank you. So I'm just going to ask the 3 of you, and Stacey, we'll start with you. Just final thoughts for the family offices listening today. Final thoughts about, possibly edge and access. I just think that's so important for everyone. So Stacey.
We joke about, open up your Rolodex. So if you're old enough to remember what a Rolodex is, open it up. Utilize your network. You don't know if you're a doctor, if you're in the medical field, look at med tech. you're going to have an edge there. You're going to be able to understand things that the average investor won't have. A lot of firms hire doctors to be able to vet decks and deal flow, because everything always looks fabulous until you look under the hood and start inspecting it. The other thing is we call it the Peter Lynch model. So whatever it is that's in your right in front of you that you notice is picking up and gaining steam and exciting. I invested in ByteDance very early because I saw my kids doing this TikTok thing and I didn't know what it was, and I investigated, and it's been pretty fabulous. So the other thing is I saw in the Q&As, I do not think that the macro events are going to affect the timeline, because this is a patient investment. This is an investment that you realize could take 8 to 10 years. It always has. That being said, I get distributions all the time. There are liquidity events that happen all the time, unexpectedly. The fund itself that you might be in, they may not close that initial fund for 8, 10 years, but there'll be sales. There'll be things going on along the way where you're either going to get money or you're going to get stock. So be patient, but it's worth it.
Oh, beautiful advice. Eugenio, final thoughts.
Understand from the managers that you're looking to invest in, what is their edge? How do they source? How do they vet? How do they win? How do they scale? And how do they exit? If they're good at all 5 of them, you have a winner. If not, focus on that and then walk before you run. Start deploying some capital before you put all that 25% of your asset allocation into alternatives.
And David Goldblatt at Vibe, you obviously, right there in San Francisco with Marty and Eugenio. Final thoughts about Vibe and just sort of final thoughts about venture capital.
Yeah, I think the reason that, and Stacey alluded to this, to get into venture capital is not just the returns, but also the impact. And it's really fun. You get to work on a very close level with these founders and people that are shaping the future and are going to be incredibly impactful over the next 10 years. So get some skin in the game. If you have 0% in venture capital and you have a large family fund, write a $100,000 check, write a $250,000 check into an emerging manager just to learn the entire landscape and atmosphere. And if you want to talk more about that, Dave at vibecap.co, Vibe Capital, feel free to hit me up afterwards.